We've been tracking the ramp up and potential scale of the de-dollarization process and why Taiwan escalations aside, it really doesn't suit China to shoot themselves in the foot by invoking the nuclear option of openly dumping treasuries to buy gold. What's becoming clearer, though, is that China has, through their secretive shadow banking operations, been stealthily converting a large percentage of these hidden 3 trillion of largely dollar FX holdings into physical gold. And once this is ultimately revealed at a time of their choosing, the price of gold will far exceed Goldman and the largest 5 first-tier banks estimate between $2,700 for Goldman all the way up to $3,000 per ounce.
As of Gainesville Coins report, PBoC starts buying gold a few months before it tells the world about it and severely underreports its additions. This was the case in 2015, 2019, and 2022. Unreported PBoC gold purchases exploded when the West froze $300 billion in foreign exchange reserves from the Russian central bank in early 2022 due to the war. Notably, the UK began exporting 400-ounce bars to China in huge tonnages at the same time. Ever since China took over gold price control from the West, it has broken the gold price's correlation with real rates. Prominent London-based metals trader Andrew Maguire expresses skepticism regarding the narrative that the PBoC halted its gold purchases in May. Despite the halt in official purchases, he highlights that data tracking from sources like Gainesville Coins shows significant gold transfers to China, including in May. Once this is revealed, gold prices might soar past current estimates, driven by safe haven demand. Probably, the PBoC wants the most gold for its dollars, so when the price rises fast, it will signal that it has stopped buying and is trying to cool the market. In the meantime, the United Kingdom exported 53 tons to China in May, of which likely most found its way to Beijing. From Maguire's perspective as a renowned analyst, these unreported purchases are likely intended to support a future gold-backed BRICS currency by shifting a large portion of their dollar-based reserves. In April 2024, China's holdings of U.S. treasuries fell from $849 billion a year before to $775 billion, the lowest level since 2009. During the same period, the other BRICS countries also decreased their holdings of U.S. Treasury bonds. India sold $1.4 billion, Brazil shed $1.2 billion, and Saudi Arabia $300 million. As Maguire points out, the substantial gold buying by China influences global supply and potentially reduces retail demand in China. Now, we present the clips of Andrew Maguire's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Let's pull apart this gaslighted misinformation that the PBoC has stopped buying gold in May. Now, taking a leaf out of the Fed's playbook, the PBoC assisted in disseminating the narrative that following 18 months of official central bank buying, gold buying, they paused buying completely. Wow. I mean, you can imagine that suited them very well. And as these reports jived with a retail slowdown in China, due really to the highest on record renminbi price gold, the Fed also jumped on the narrative bandwagon to cap and short sell gold, seeking to cover off some deeply underwater derivative bets. Now, to this end, having such deep pockets to hunt out spec longs, to that end, they have succeeded. However, while official gold purchases official ones did stop in May, based on supply and demand flows, as we mentioned in June, our liquidity providers had already been countering this narrative. Now we have empirical evidence that monetary gold purchases actually increased. Now, the PBoC does not buy gold through the SGE conduit. And as any savvy buyer would, they accumulate gold well in advance of announcing their official purchases. However, monetary gold does not need to be reported. And given these transactions are primarily conducted in dollars, euros, Swiss francs, pounds, in the form of 400-ounce 995 bars, and that there are 47 customs entry conduits and 4,000 customs clearance control stations, by design, it's impossible to track the scope of all the PBoC's monetary gold purchases. Also, our first-tier liquidity providers continue to report a race by Beijing to buy as much gold as possible ahead of the BRICS gold-backed currency launch, and telegraphed sanctions and duties which are going to be imposed after the US elections one way or another. Now, we also note that under the radar, the over 3 trillion of largely dollar-denominated shadow banking reserves that former US Trade and Treasury official Brad Setzer warned about, and as seen here in this Bloomberg link, are surreptitiously being exchanged for bullion in all its forms, including gold and silver in raw form. Artisanal gold, doré bars, direct mine investments, and forward purchases of bullion at market prices. Now, some of the data can be measured by tracking the 400-ounce bullion flows exiting London, and Jan at Gainesville Coins does an excellent job of actually tracking what's actually reported. And he noted that 53 tons of 400-ounce bars were shipped to the PBoC in May alone. So there's some other empirical evidence. Now, these monetary gold purchases will also not be reported by the PBoC because they're monetary gold. And just as unreported PBoC gold purchases exploded when 300 billion in foreign exchange reserves from the Russian central bank were frozen by the West in 2022, due to the war. Notably, the UK began exporting 400-ounce bars to China in huge tonnages at exactly the same time. That's what's going on now. It's no coincidence that the PBoC gold purchases stepped up significantly after the EU froze 260 billion euros of Russian assets on the 21st of May, really essentially stealing, confiscating an ongoing 3.5 billion generated by these assets to back a 50 billion loan to Ukraine. And given the PBoC is stepping up its purchases, it's going to tighten up global supply. And the early stages of this is really sucking supply to retail buyers in China, which actually, Jan assesses, could actually be a reason for the downturn in retail demand, which makes sense. Now, as subscribers will know, we've been tracking the ramp up and potential scale of the de-dollarization process, and why Taiwan escalations aside, it really doesn't suit China to shoot themselves in the foot by invoking the nuclear option of openly dumping treasuries to buy gold.
Regarding the Federal Reserve's recent attempts to cap gold prices by borrowing over $500 million in bullion from the BIS, Andrew Maguire underscores that these efforts have worsened their underwater short positions. He predicts that the Fed will need to buy back this gold at higher prices, potentially driving gold to $3,000 per ounce. Despite Monday's sharp drop, gold is still up about 15% so far this year, and is one of this year's best-performing commodities, aided by central bank buying, Asian consumers, and expectations the Fed is getting close to cutting rates. From a technician's perspective, Maguire's analysis suggests that gold's upward trajectory is set to continue as the Fed navigates its ongoing challenges. This dynamic resembles past market movements, where the Fed's actions and central bank bids drove significant price increases. Let's get back to the interview.
Looking at the bigger picture, which backs up how central bank demand has been hidden by the Fed's recent efforts to cap gold into literally billions of dollars of deeply underwater OCC OPEX bets. Remember, the Office of the Comptroller. These are FX bets that sit outside of the futures market and on top of the futures market liabilities. And liquidity providers estimate they aggregate to around probably $1,900 per ounce. Now, we may have seen that rise to $2,200, but that's not 100% clear yet. Now, the Bank of International Settlement swaps have, during this last period of time, have increased by 7 tons to 116 tons. So let's put that into context. This 7 tons represents over $500 million of real bullion borrowed by the Fed to finance their capping efforts. And while this bullion does not physically leave the Bank of International Settlements site account, on paper, this loan bullion is leveraged by 96%, creating 670 odd tons. That's 52 billion of COMEX supply. Now, that's a hell of a lot of velocity there. Now, the Fed is the only central bank that has not been able to exit their historical naked short bets against gold. Every ounce of the current outstanding 116 tons of gold borrowed from the Bank of International Settlements by the Fed will have to be paid back at significantly higher prices. Now, if they had managed to offset any of these bets into the $600 physically driven rally from 1900 to the recent test, very close test of 2500, they wouldn't have needed to borrow more gold from the BIS to enable them to mark these billions of dollars of OCC, OPEX bets to market, on the 25th of July. Now, we illustrated the exact mark-to-market event on the charts earlier. And just as we showed when the Fed triggered central bank bids sub 2,000 in mid-February, which we also looked at, and it forced them to face up to what was then T+2, NSFR compliant delivery obligations, meaning that you tag that spot price, it had to be delivered in 2 days. That's now reduced to T+1, which is 1 day, which is another reason the BIS brought that in for the very reason that we discussed earlier. They need a liquid price for gold because they are actually now competing with the Fed. So basically, what happened was that the Fed had to go to market to buy gold at market, driving that initial $450 rally in gold almost without a pullback. Now, so really to answer the question now, having once again been forced to cap gold into these increasingly wrong-footed technical NSFR compliant FX multi-billion-dollar OCC bets, what they've done now is trigger fresh, much higher weighting central bank bids at 2,400. We just saw them actually capitalize on that. It's toing and froing above that, and each time they tag it, they're filling more. And even though they can offset some of it against the CTAs, this is aggregating. This is not what they need. And once again, what they're doing is digging another hole, just like we saw in February, March, April, May as well. So net of available fast contracting COMEX CTA open interest chips to offset their deeply underwater naked short bets into strong global central bank demand, the Fed will once again have to buy back these naked short bets at market, potentially driving a rally into the 3,000s. Just like in February, this is setting up a higher stair-step to rally from.
The interplay between central banks and market forces might drive gold to new peaks. Commodity analysts who make long-term forecasts believe that the price of gold will generally keep rising in the next few decades as the demand for the precious metal increases. In the rational case of $7,000 in gold by 2030, economist Charlie Morris predicts the $7,000 price milestone. He describes gold as the leading asset class in the 21st century, which is an extraordinary achievement given that gold doesn't pay a yield. How do you think the recent trends in gold purchases by central banks will impact the future price of gold? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.